G'day guys, Andrew Blackburn from Buy and Sell Zones, and I'm in Brisbane, Australia. Welcome to you, wherever you may be around the world. Big g'day from Australia. Today we're going to have a look at a video and a course actually put together by Sareed Harper from Pipnotic. Now Sareed is an expert in supply and demand. In this video he's going to talk about what is supply and demand, identifying valid supply demand levels, also how to analyse a chart. We'll have a look at some trade entries and some trade management. So it's a fantastic course. It's not going to cost you a cent. And have a look at this just behind me here and you'll see how the software actually works and how it identifies buy and sell zones and supply and demand areas. So it has taken my trading to the next level. If you want to do the same, click down below. There's a link which will get you through there. But in the meantime, let's check out Sareed's video. Have a great day, everybody. See you next time on Buy and Sell Zones.
Hello there and welcome to this video. In this video I am going to discuss trading supply and demand, and the purpose of this short course is to attempt to demystify the process. A lot of people view trading supply and demand as kind of a black art, and while it is extremely powerful, it is also simple. And so this is something that I'd like to drive home throughout this presentation, and I'll show you a pretty simple way to effectively perform an analysis of supply and demand via top-down analysis that will enable you to identify levels that you can trade at. So all the examples, when I start showing examples on live charts, they will be done and performed using the Pipnotic supply and demand software, which you all have access to. Okay, so let's get started. Okay, a quick overview. We have an introduction, and I'll discuss what we're going to learn when we take this course, this short course. Then we'll talk about identifying valid supply and demand, and then we'll be doing an analysis of a pair chart, perhaps a few. Then we'll have a look at trade entries and trade management. So nice and to the point. Introduction. This is very important for obvious reasons. The first point being that trading is not rocket science, which it really isn't. If anyone tells you that trading is something that's super difficult, rather super complex, it's not. It doesn't have to be, at least. While it can be extremely complex, it doesn't have to be. And the way that I like to trade currencies and the way that I encourage you to do so is to reduce this to a very simple process. And if you do this, then I think you'll have more success than anything else. If you start introducing a bunch of complex tools and indicators and this and that's, then you will be so overwhelmed with the complexity of trading that you will perhaps give up. But I'm telling you that it is not complicated. It is actually very simple. That said, despite the fact that trading is and should be simple, it does not in any way make it easy, because it is the furthest thing from easy. And this is because that you are dealing with yourself. You have something that's very simple. You have theory, you have tools that you can apply in order to understand the market and to capitalize on the movement of price, but doing so is up to you. And so the software will tell you to do something, but it's up to you to do it. And so you will constantly be dealing with your own emotional hiccups whilst trading. So this means that you'll be looking at a price chart. You're told that you should be buying here or selling there, and you have to do it. You can lead a horse to water, but you cannot force it to drink. And this saying goes very, very well in trading as well. It's a tough thing, trading. You have to learn to be okay with not knowing what's going to happen next, and so you have to understand also that you don't need to know what's going to happen next in order to be profitable. You just have to have your edge, which we have a very good edge with the supply and demand software and the theory that we'll discuss. And that's all you need. Then you have to apply your edge, and failure to do so will result in inconsistency in your trading results. So yes, trading is it's therapy, because you learn a lot about yourself. You'll experience yourself in various emotional states. You will be, in some circumstances, you'll be insecure, and others you'll be overconfident if you have a winning streak. You'll be scared, you'll be greedy, you'll be fearful. Sometimes you'll be in a trade and things are going so bad, or you're managing the trade so poorly you'll have to run out to use the toilet. It's an emotional roller coaster. And while winning trades is good, you shouldn't become euphoric each time you win a trade. You should say, okay, good, that one worked. And the same applies for losing trades. If you lose a trade, you don't have to vomit or get sad. You say, okay, that one didn't work out. It doesn't matter. Individual trades alone mean absolutely nothing. You have to look at the bigger picture. You have to look at a sample size of 30, 40, 50 trades, as this is something that's going to be the most telling. So remove the focus from individual trades and focus on trades over the course of a month, and you'll have a much better insight into what's going on and how you're doing. Okay, what we'll learn in this course, we'll be looking at how to identify price sensitive levels, and these areas are so brilliant that you'll almost always have the opportunity to reduce risk, because price almost always reacts at these levels, and this is quite nice. We'll also look at how to qualify valid supply and demand, because while the software will draw a level on the chart, maybe it's not a valid area, and you have to know how to qualify in order to validate a particular area of supply and demand. So we'll look at how we draw these valid areas of supply and demand. We'll also look at how to define supply and demand based entries, stops and targets, and then we'll also discuss briefly trade management. Okay, so what is supply and demand? Supply and demand is pretty simple. This has been around since people started buying and selling things from each other. So we have supply, which represents how much of a product or a service is available, and then we have demand, and this refers to the quantity of a product or service that is being demanded. So if you have a product or a service that is in high demand, this will generally cause the price to increase. And the same applies, so the opposite applies for supply. If you have a great and increasing supply of a product or service, this will generally bring the price down. And as traders, we are looking to identify these imbalances in supply and demand and capitalize on them. So how do we identify valid supply and demand? Well, I like to use these two points here, these two rules. And the first rule is consumption of opposing supply and demand. So if we have an area of supply or demand, we want to see opposing supply and demand being consumed by the area that we are looking at. And if it does, then this automatically qualifies the area that the move originated from. Additionally, we have something called a trend line break, and a trend line break is ultimately we use trend lines to define the structure of a market. And so if we have an area of supply and demand which is strong enough to break the structure of the market, then we know that there is enough muscle in this area of supply and demand to cause the break, which also qualifies the area of supply and demand. We'll look into this in greater detail shortly. I would like to have a quick look at how this might work on a chart. So if we have a quick look here, let me move my chart over here like this so we can see what's going on. Then we'll have a quick look here and we'll look what's going on. And the first rule, which is this one here, consumption of opposing supply and demand. Let's have a look at something here. Okay, if we have a look at this area of supply, what is it that makes this area a valid supply? Well, according to the first rule, it has to consume opposing, in this case, demand. And did it do that? Well, then you have to backtrack and you have to identify valid areas of demand. So we'll do that very quickly. We'll draw, this is an area here which looks interesting. We'll just draw that in. And you can see that when price left this area here, it moved down to the top of this area of demand, and then it came back and it consumed this area of demand. So that qualified this as valid supply. So now we can move this up here. So now we have this area, which is interesting. And so this is a valid area of supply. And then you have to look at, for example, the areas down here. Then you have to qualify these. Okay, let me update that. There we are. Is this a valid area of demand? Well, did it, according to rule 1, consume opposing supply? And this is the area of supply. And did it consume opposing supply? Yes, it did. It moved through it here. So this becomes valid demand. Oops, let me draw that properly. We draw like that. And you can see that this area just here is a little bit higher than this one here. This move originated from here. And so this is what I refer to as a parent demand, and this is child demand. And the more powerful of the two is the parent, because this is a reaction to this, but this is the original area of demand, which I will call a parent. So if I'm referring to an area of supply and demand as the parent, this is the more significant area that I'm referring to. And while price will often react at child supply and demand areas, it is more likely to react at parent supply and demand. So this is just a couple of terms that we should be looking at. So here we can see how we are validating areas of supply and demand. We can also have a look at the major swing points, the highs and the lows. So we have, if we zoom out, we have a very significant high, and when price reached up here, then it sold off very quickly, and when price left here, it consumed all of this micro demand all the way down here. So this qualifies this area here. So we can draw this one in, and if we go like that, we can see here that we have, this is the parent and this is the child, because the child, which is here, is reacting to the one above it, which is the parent, which makes us the child. I hope that's clear, because it's quite important. If we have a look at, let's maybe have a look at another pair. Let's go to the pound here. We can see that we have this high. When price established this high, when it left here, it managed to consume this area of demand, child demand here. It bounced off the parent, and then eventually it managed to move below. And so this area here is qualified. So we'll draw that in. And we can also see that we have some others here. Here we have some micro demand here. And the lows were taken out when price left just here. So you can see here that this area here is looking pretty interesting, because when price did leave, it managed to move below these lows here. So let's refresh that. So it's Friday evening, so the market is slowing down to a halt, which is why we're not getting a lot of tick data. But you can see here that we have demand here, and then price is moving down, and then now price is slowly turning around. So now we can look at areas here. You can see here we have a pretty substantial low here, which qualifies this as demand. So we can just draw this in. And when I draw these, what do I look for? Well, normally I like to look for where price broke away, and the indicator is drawing this for us nicely by marking one of these candles as green. So this shows us when price left the station. And then it's also drawing these white candles, and these candles are accumulation candles. And accumulation candles simply tell us where orders are being accumulated to push price either higher or lower. So price came down here, we had a push into this area here, we had order accumulation at the bottom here, and then you don't know if the orders that are being accumulated are to sell or to buy until price manages to break away. And you can see here that these order accumulation candles here were accumulating buy orders, because this is the direction that price moved to. So this qualifies this area down here as valid demand. So we'll put that in like that. So we have something like that now. And then each time price moves above, you can see here we have this. This is a valid area of a supply because it took out these lows here. And so where did the price originate from when it moved past this? Well, it originated from here. So we have this candle here, like that. Perfect. And then we have some more kind of messy price action just here, and it was taken out just here. And this is kind of a continuation pattern, how price rallied, accumulated, and then rallied. And then now we have price which is contending with this area just up here, as you can see here. And this is nice because this area of demand here was taken out when price left just here. So this is what we're currently looking at now, and this is opposing supply and demand qualification rules. But we also have trend line breaks, which we'll also look at now. If we consider for a moment drawing trend lines, you can draw trend lines, but you have to do it in a valid way. You can see as an example, if you want to draw a trend line on this, what you need a high, a low, a high, a low, high, low, high, and low. And you can do it like this, just to move it like that, just to make it clear. And what you want to do is you want to take the two most recent swing lows or swing highs, but you can't take any because they have to be validated first of all. Okay, let's assume that price is right here. This doesn't exist. What do? Well, first of all, we have to find the starting point, which would be the first swing high. So this is the first one here. This is number 1. Then we have to find number 2, which is this one here. And why can I use number 2? Well, I can use this one because when price left point 2, it managed to move below the low here. So the trend line for this would go like that. Like that. And this is how they draw a trend line. So it's pretty simple. We can try and draw another one here. So let's assume that we have a trend line here. We have low, high, low, high, low, and high. What do? We take the two most recent swing lows. So we have the first one, and we have the second one. And why can we use this one? Well, because this one took out this high. So the trend line for this would look something like that. Okay, so once you've drawn your valid trend lines, then you have to look for something called a trend line break. And trend line breaks are important because if let me draw something here. If you have like some, wrong tool. If you have prices moving up like this and down, and we draw our trend line like this, and the area of demand down here is only qualified once price breaks above the trend line. So let's assume for a moment that price goes like this, touches the trend line, comes back, we have a deep retracement, and then it moves through. That qualifies this as the parent demand and this as the child demand. So look at something like that. And so then you have to ask yourself, what area of demand is responsible for breaking the trend line? It's this one here, where the parent is here and the child is here. Maybe we don't have a parent and child, where we have something that looks more like this, where price just comes away like that, and it kind of just shoots through like that. Then we only have this one down here, which will look something like that. And then this area is qualified as valid demand, but it has to break the trend line. Like that. So these are the two rules for qualifying valid supply and demand. And I'll cover this in detail shortly in the coming analysis. So the first one we looked at is consumption of opposing supply and demand. This is the most powerful way to qualify supply and demand. But we can also look at trend line breaks. Okay, good. Let's continue. Okay, if we want to analyze a pair chart, what do? We can do this in two ways. We can do a full analysis, which I will encourage you all to do always. But you can also do it in a quick way, and I'll go over this in just a moment. So if we start with the full analysis, what we do is you first of all you have to pick your style of trading. Are you a position trader, a swing trader, or a day trader? Would you like to open trades and hold them for days or weeks, or do you like to be in and out of your trades within one trading day? It's important that you know this, because if you're uncertain of how you like to trade and you're trading a way that is not fitting your personality, your mental makeup, you'll probably experience some trouble. And so it's just good to spend some time experimenting a little bit and doing some short-term trading, medium-term and long-term trading. I like to swing trade. I did scalping, which is very short-term, which is based on currency strength. I've done day trading, but I feel more comfortable doing swing trading. I think eventually I'll move over to position trading, but I like the longer-term stuff where you put in your order, you don't have to pay too much attention to the news, and you just let your orders get filled, and then you have a day or two to assess what's going on and how you're going to manage the trade. It just slows things down. So once you've decided that, then you're going to have your 3 different time frames. So for the swing trader, which is what I am, the long term for me is going to be the weekly, the medium term is going to be the daily, and the short term, or the entry time frame, is going to be the 4-hour. If you're position trading, then the long term is going to be the monthly, the medium term is going to be the weekly, and your short term or entry time frame is going to be the daily. And for for day trading, your long term will be the daily, your medium term will be the 4-hour, and your short term or the entry time frame will be the 1-hour. But for the analysis that I'm going to do here in this example, I'm going to do swing trading. So my top-down analysis will start on the weekly and it'll go down to the 4-hour. So what we want to do here is we want to start on the long term or the weekly. We mark off supply and demand, and then we go to the medium term, we do the same, and then we go to the short term and do the same. Then we draw trend lines so we know what's going on, if we have any, if we're able to qualify areas of supply and demand. And that's pretty much it. It sounds pretty heavy and time consuming, but it isn't. Okay, let's have a look at some examples here. Let's have a look at at the euro. So if we, is there a price? Okay, so let's have a look. We'll go to the weekly and we'll start our analysis there. Miss the entry there, we'll just delete that. Okay, so now we have to ask ourselves what's going on here. Well, the indicator is bringing a lot of information to our attention. It's telling us where we have areas of supply and demand. So you can see if you hold the mouse over this line, or if you open the indicator and you have a look at the settings, you can see here that the orange lines, which are these ones, are the weekly supply and demand, and then we have the purple, which are the monthly. And so the colors will tell you the significance of the area of supply and demand. And so we have pretty significant areas on the chart here. So now we have to qualify these areas and draw them. Right, we have this one down here. Is this valid supply and demand? Sorry, is this valid demand? Yes, it is. Well, why is it? Because when price left here, first of all, price has not been back since. So this tells us that there was a lot of buying pressure, a lot of demand at this level for the euro-US dollar, and price moved up and it held away and it has not been back, and it's continuing to move higher. So this tells us that this is a very valid area of demand. Also, when price left here, it came up here and it eventually managed to consume this continuation pattern almost entirely, and it happened here like a few weeks ago, which was great. So this is an area that we are going to use, and you can see that the indicator has drawn it here. It's been qualified as a weekly and a monthly area of demand. So we'll draw that in quickly. And again, how are we going to draw this? Well, first of all, you want to look for the green bar, which is this one where price left, and then you look to the left and you say, are you an accumulation bar? Yes, you are. And you look to the one to the left, are you an accumulation bar? No, I'm not. And so you stop your analysis here, and then you mark the area from the top, in this case the top of the body, to the low, which goes down to here, which is like the low of the green bar. You go like that, then you do that. I'm just going to remove these lines because we know where to look, just so it's a little bit clearer. So we have this area of demand which is untested and fresh, which is beautiful. And then, so this is the bottom at the moment. So this is actually price is not touched here. So now we want to find something at the top. What else do we have? Well, up here we have this nice area here. You have to look for the green candles where price left. When price left here, it took out this demand. So this qualifies this. So we'll add our rectangle here and we'll draw it like that. And you can see that that this is actually what's currently in control. So price, it tested this and now price is moving lower. But you can see that price has paused here. And why is that? Well, you can see that we have another green candle here. Price left, and you look left and you say, are you an accumulation candle? Yes, I am. So we are able to draw another area of demand, just like that. And price touched that almost to the pip, and now price is reacting to that. So something's going on down here. And now we can draw our trend lines. So we need to be able to qualify these trend lines. And so we have a low, high, low, and high. So our first low is here. The second low is here. And why is this valid? Because the high has been taken out when price left this area here, which qualifies this. And so our trend line will go something like that. So we'll just do that quickly with a proper drawing tool. So from the low up to there. And this is what we're currently looking at. We don't have a trend line break because we want a full body close below the trend line to cause a trend line break, but we haven't had that yet. We're just having currently a reaction to this weekly demand. Okay, so now we go to the daily chart, which is our medium term, and we'll adjust these lines here as well. Like that. Now we can do the same here. Right, so now we can see that we have, we can see the structure of the market, how we have some pretty nice areas of supply and demand marked off. You can see here we had this major area of supply and price left, and now it's testing this for the first time. So this area has now been tested. Price came down and now bounced off this demand, and now price is moving higher. Excuse me. So now we have to look for areas where we can draw supply and demand. Well, you can see here that we have a high here, and this is a nice pattern how price went up, touched this demand, and then rejected. So we can draw an area here like that. And if we look to the downside, you can see that we have this low here where price came down and moved high, and it's almost taken out this continuation pattern. And so we can use this one as well as valid demand. We look for the green candle, look left, accumulation yes, accumulation yes, accumulation yes, but the body of the bar is higher than the highs of these two here. So our zone will be from the highest body to the low, which is down here, and it'll look like that. And we'll remove that one. So that's what that demand looks like. But you can also see we have price, it's sold off, it accumulated, and then it sold off, accumulated, and sold off, and currently reacting on the bottom accumulation pattern here. So we can draw a couple of more areas in here, from here to here, so a pretty thick area. Then we have another one from the low of the bodies to the high. and this is what price is currently testing now, and you can see that price has actually almost taken this out. And so once price moves to the top of this, then we can remove that and delete it. And then the next area that we'll be looking at is this one here, but we'll leave that like that. We'll leave that like that. I just have to change the name so the indicator will find it and add some labels to it, just like that. There we are. and that's what we're looking at. And so for our trend line, what can we do here? Well, you want to use clear swing points for trend line points, and we don't really have any on this move down here, but we do have this low, high, low, high, and it's pretty much the same as the weekly trend line, so we'll leave that for the time being. We shan't touch that. Now we go to our entry time frame, or the short-term time frame, and we do the same thing over again. You can see that we have this area down here. We have currently price is reacting on this daily supply, so price left this base, rallied, accumulated, and then rallied. We had a NFP today which caused this big push, and then price reacted nicely on this area of supply. So we can draw a more refined entry for that here, like that. Price almost came up to it, and we have this continuation pattern here, which is not quite qualified because we want price to move high and accumulate and hold away before it comes back. So we'll wait in drawing that. So currently the only qualified area of demand on the daily is the one down here. So this is what we're looking at here. So if we look at a trend line now for the time being, we want to see some clear swings where we have kind of a high here. Let's draw these manually. We have like a high, low, high, low, high, low, high. And so we can actually draw, we have our first point, we have our second point, and the reason this one is valid is because it took out this high. So something like that. So our trend line can go from here to here, like that. So we have a 4-hour uptrend. So this is what we're currently looking at on that. So the analysis is pretty quick. What it takes is about 5 minutes or so to do. And so the bias that we can see here is that we're currently reacting on weekly demand. So we have weekly demand in control at the moment. And so just be mindful of the fact that weekly demand is stronger than daily demand, which is stronger than 4-hour demand. So until price manages to move through this area of weekly demand, this weekly demand is currently driving price. So we'll probably see price continue higher if this theory holds. But that's what it looks like. Okay, let's go back to the slides here for a moment, and we'll look at the next one here, which is the quick. So that was a full analysis where you start on the higher, sorry, the long term, you go to the medium term, and then the short term of the entry. And it takes a little bit longer, you have to draw a little bit more, but it's really good practice, and I highly recommend that you do it. But if you're not into that, all that hard work, then you can opt for the quick analysis method, which I, on a rare occasion, may use, and it looks something like this. It's very quick and very almost you can automate it. The reason I've made it a cycle like this is because you can pick a pair, do analysis, go to the next pair, analysis, next pair, analysis. So what you do is you go select a pair, go to the entry time frame, which for me is the 4-hour chart. You zoom out. Are we buying or selling? Look for the green candles, look for the white candles next to them, draw the areas like we did in the previous example, and then you place your entry, stop, and your target. So let's have a quick look at that and see what that might look like. So if we remove all of these, so we want to look at the 4-hour. Let's take Yeah, we'll leave it. We'll use the same one here. So we'll zoom out, and you can see what's going on. Are we moving up? We're moving down. So you zoom out. Sorry, you can see here that price is kind of sideways. So let's maybe pick another pair. Okay, we have this one here, which is moving higher. You can see price is moving higher. So what we do is we want to look. We'll go to the next step. Zoom out. So we want to be buying. We're down here, and then we look for the green candles. And here we can see we have one here, we have one here, and we have another one here. What do we do then? We're going to look at the accumulation candles, and these tell us where the area is, and then you start drawing these areas of supply and demand in. So for a shape, you would go from, here's a green candle. Is this one of the candles that moved away? Yes, it is. And you can see how the body is higher than the wick here, so you'd want to use the top of this body here. So we go from the low to the top like that. That's the first area. Then you'd look for the next green candle, which is here. And then you can see we have the green one. We have an accumulation candle right next to it. We'll go like that. So it looks like that. And then down here we have something else going on. But I don't like this. Is a little bit too messy, so we shan't touch that. And we have this one here, which has been, this area of supply has been consumed by this area of demand. So we want to keep going backwards, and we have another green candle here. We have some accumulation candles here. This is a nice one, so we'll draw that in from the high of the body. I think I'll take the lower one, a little bit more conservative, to the low here, and it looks like that. So let's remove our lines because we know where we want to draw. Then it looks like that. And you can see how this area of demand was tested, and now we have a couple of continuation patterns. How price rallied, accumulated, rallied, and we have kind of another one in here which we might draw. We don't have any green candles, but it's like it was a pause, like a move in the opposite direction, which is a pause. So we go from the high to the low because you can see that the bars are very wicky. So we go like that. Good. And then this is what we're looking at. And then you want to find out where you want to enter. Well, what would you normally do? Well, which one of these do you take? Do you take this one, or that one, or that one, or that one? Well, ideally you want to take the one that's closest to price, which would be the one in the top here. But judging by the fact that price is super overextended here, I would probably want to look for a bit of a deeper retracement. So I would probably wait for price excuse me, to come back down here, because this is a little bit of a more solid area of demand. And if you want, you could go to the daily chart and you could have a look and see what's going on there. And you can see we have this huge push up here, and the area we looked at is right in the middle of the big push. So I think that this is probably the one that's more valid here. And if you want to draw a more aggressive area, then you could draw it like that, for example. Yeah, so the area looks like that. So that is the 4-hour analysis. It's pretty quick, a lot faster than the other one, and then enables you to very quickly identify areas that you could consider for trading. The reason that I'm not that fond of this one is because that you are not always going to be mindful of the greater period supply and demand here. And let's have a look at an example. This is a great example of this. So we're looking at the Aussie US dollar. If you go to the weekly, what's going on? Well, you can see that price, let's assume that we would have been buying here. This is a bad example because price managed to move through it, but you can see that we have the parent supply here, which goes like that. And price, if you're going to buy here, you would be buying into weekly supply, which is not a really good idea. Not until price moves through this area of supply, and that qualifies this tells us that price is very likely to continue higher up to some of these other areas up here. So you can see that this one is basically taken out. It was established, it was tested once, twice, and this is the third approach, and it failed. We are just about to completely consume the liquidity of this area, so we can remove that because this is no longer here. So this is actually telling us that we could continue to buy, which is quite nice. But let's assume that we had this big area of supply here, and this was the first test. Then price is probably going to respect it and move back in. And unless you're on the weekly chart and you're looking at the greater period supply and demand, you're not going to know that. And so you just have to be very careful and just pay attention to what's going on. So when you're on the short term like this, just have a really good zoom out and just see where price is in relation to the greater period supply and demand. Okay, good. So that was the quick analysis there. What about trade entries? Where would we put our entry, our stops and our targets? Well, let's have a look at that. Well, ideally you want to put your entry just below above the area of supply demand, and this is because often price won't come directly to the area, it'll come just above it. The orders will get filled and then it'll take off. And also if you're buying, you have to consider spread as well. So it's just a good idea to put it maybe a few pips in front of the area. Stops you place on the opposing side of supply and demand, maybe plus or minus 5 pips. And for targets, this requires an analysis of the price action that approached the area. So if we have another look at the chart, and we assume that we want to, like, let's just delete these and say that we want to, actually I saw something that's pretty interesting on the Swissy. Let's remove these lines just to clear it up for us. So let's assume this for a moment. We have this area of supply here. This is supply because it took out this demand, and this is demand because it took out this supply. Just so we're clear, and we'll draw this one in from the high to the low. So then, perfect. And it's been tested once, twice, so it's been tested 2 times already, so it's probably so price will have an easier time moving through this. You could consider an area of supply and demand as a stack of pancakes, where I'll draw these pancakes in where you have a pancake here, another one there, another one there. Some of these pancakes are thicker than the others, they're not all the same. You got another one, you have a really thick one here, and you have a bunch of thin ones like that. Okay, and so when price comes up into the area, consider price as it moves up into the area as a fork, and the fork comes, and you can see that it's eating the first pancake and the second pancake. And so in the stack of pancakes, if a fork wants to get a pancake on its fork, it's going to have to move deeper, so it's going to have to go to this one here, and this is a thick pancake, so it's going to require a big fork. And then price will come away, and now when price wants to go in additionally move in, it's going to have to go deeper into the stack of pancakes to grab a pancake. And you can see that every time price feeds into these areas, these stack of pancakes, which are ultimately pockets of liquidity, are consumed by the hungry eaters, and it goes like that. And eventually when there are no pancakes left, then you have to start looking for a new plate, and the new plate of pancakes will be, for example, up here. That's probably what we're testing now. Yeah, so that's where price is testing now. So now we have another stack of pancakes. So once this one is eaten, then we have this stack of pancakes here. And then price will come down, eat the first one, second, third, fourth, fifth, sixth, and so on. And eventually this will be eaten, and then we have another stack of pancakes up here. So you can consider areas of supply and demand as stacks of pancakes, if you will. And so let's assume for a moment that this area, we want to trade this area. Where do we put our entry? If we have a close look, you can see that price has kind of fed in, so we have the pancakes at the bottom here have been consumed, and so now we have pancakes that are from about here and up. So our entry would go for this would go about here, and our stop would go over the top like that, about 5 pips above, something like that. And then our target will require an analysis of price as it's coming down. So if we just assume that we look at this now, you can see that price touched this and it's held away, accumulated away, and now it's coming back. We want to target the areas down here for our profit targets, and this requires that we have a look at opposing areas of supply and demand. So we can draw another one in here. We take from the low to where price dipped in right there, because this kind of defines the edge of the area. And so this would be a very logical area for us to have a target. So our target would be just above the area here, or you might want to target just above this child demand, so about right here, like that. So this is what a setup would be for this pair here. Remember, you could put your entry here. Remember, the liquidity on the edge of this area has already been consumed. The pancakes have been eaten, so we have to move deeper into the stack of pancakes, which is up here. So that would be the best shot. So we'll probably have a deeper push into this area on the next approach. And who knows, maybe price might even move through it, but time will tell. So this is what we're doing for our entries and our stops and our targets. So if we have another look at a different one, let's pick another pair. It doesn't really matter what it is. Let's just draw a random area, and we have the top here I like, from the high to the bottom of the body. The entry would be here at the bottom, just below it. Our stop would be here, and our target would be, we would have to look at the way price moved as it came up, like this, for example, and we'd probably want to put something, have our targets in that kind of target these areas here, something like that. So when price comes down, it'll probably react on here and have a bounce, and then react on another one that's established here. Here we have a parent and then a child. So we'll probably have a reaction here, and then price will maybe have a go, start eating at the pancakes, move through, and then it'll start looking for the next pancake plate, which is down here. And it'll start eating through that and then going down. So you want to put your targets just above those stacks of pancakes, if you will. I hope that's okay that I'm using pancakes as a metaphor for this. So it's pretty straightforward. Good. What about trade management? What are we doing for trade management? Well, this will vary, of course, from person to person. I like to get the risk out of the trade as soon as I can. I don't like taking a full stop if it can be avoided. And so the best thing to do is to a simple rule that I do is I have one position that's broken up into two sizes, equally sized, and I will have my first target will be 1-to-1. And so once my first target is hit, this will pay for the stop on the second half of my position. So I can leave the stop where it is, and then I can just let the trade unfold and see what happens. But what I'll normally do is once my first target is hit, then I'll move my stop to break even. So I am certain that I'll get that bit of profit and I won't give it back. But sometimes you'll get stopped out at break even on the second half, and that actually happens quite a lot. But the most important thing to remember here is not to micromanage your trade. When you're trading on the bigger time frames like the 4-hour, the daily, and the weekly, you simply have to let the trade unfold. So you get in the trade, and then you have to walk away. You can't trade it like you're scalping. You have to get in the trade and you have to leave it. And the more you fiddle, the greater the chance of you getting stopped out because you're trailing your stop too tightly. You just have to give it a little bit of air so that it can breathe, and so price can breathe and move higher and lower. So it can wiggle up and down on its way to your target. And if you're trading in line with the more significant supply and demand, like the weekly supply and demand, then price is probably going to drift in the direction of the thinnest liquidity, which is away from the weekly supply and demand. So just keep that in mind. Conclusion. Yes, it's very important, I'd say, that you invest a little bit of time in discovering how it is that you like to trade. As we spoke about briefly earlier on, are you a position trader, a swing trader, a day trader? Would you like to do short-term trading, scalping? Spend a bit of time on a demo account and figure out exactly what it is that you're looking to do when you trade. We also looked at two different ways to perform your analysis. We have the full analysis and we have the quick analysis, which I call KISS, keep it simple stupid, and the KISS concept applies to both of them. Don't overcomplicate stuff. If you're looking at a pair chart and it's not clear, you're not seeing anything, don't force anything, don't overcomplicate it, just pick a different pair. But I will always recommend to use the full analysis, because you are really going to be a lot more mindful of what's going on the grand scale. So do that. Once you get more comfortable, then you can move to the quick analysis method if that's what you choose. And finally, if things look messy, change pairs. There are so many different pairs to trade. If the dollar yen is not doing anything, it's just kind of going sideways or looking choppy or whatever, go to a different pair. Just look for something else. You don't have to force the trade. You don't have to trade the euro US dollar because you like it. You simply find another pair that's working out and then you trade that one instead. Good. Okay, I think I will leave it at that. I hope you saw value in what we've presented today. If you have any questions about anything I've discussed or you have any comments, I would love to hear from you, and so please send in your comments. That's it. Thank you very much for watching.